Do you want to be a successful trader so you can be profitable week after week, month after month? Do you want to understand mental discipline and develop a systematic step-by-step approach? Do you want to learn to control your trading behavior? Then let's listen to a classic book in the trading sector, The Discipline Trader by Mark Douglas. Welcome to the Hindi audiobook. In today's episode, we're going to talk about this great book by Mark Douglas, The Discipline Trader. What did Mr. Timothy, president of Computer Act Software, Inc., say in his letter? Let's find out. Mr. Timothy says that his unique position in the financial world has given him the rare opportunity to speak with thousands of traders, brokers, and trading advisors since 1999. He's not a broker or a letter writer. He is the CEO of Computer Act Company, which provides technical analysis to stock and futures traders. He started trading for himself in 1960 and very quickly became aware of the inherent psychological barriers to good trading and money management. This realization has been confirmed by all who have worked with him. He sincerely feels that trading success is 80% psychological and 20% anyone's methodology, whether it's fundamental or technical. For example, you may have a basic understanding of fundamental and technical information, but if you have psychological control, you can make money in trading. Conversely, if you have a great, tested system that has performed well over a long period, yet you lack psychological control, you'll be at a loss. A good trader knows from experience that over time, he may be connected to more losing traders than winning ones, but careful evaluation of risk, protected by money management and realistic stops, will keep the trader out of trouble and ensure they profit from big moves. Money management is composed of two essential components: psychological management and risk management. Risk management, stemming from psychological factors that are actually understood by traders, is effective before considering risk. He would specifically warn new traders and market participants that while analyzing your inspiration from reading and passive analysis is certainly necessary, the real acid test comes with the pressure of an active trade. So start slow. Question every trade, like what inspired it, how the trade was managed, was it successful? If so, why? Did you lose on it? If so, why? Write down your valuation and review your comments before the next trade. At all major Compute Track seminars, he tries to have the workshop leader tell the attendees about the psychological aspects of trading. That green goblin that kills your equity and makes your profit disappear is none other than you yourself. Just as every criminal says just before committing a crime, I know what bad thing I'm going to do, but my irrational self is stronger than my resolve. Similarly, when you trade, if this feeling comes to your mind, then this book takes the form of a trader's extensive rational dialogue. When you read or listen to it, you feel like your friend is explaining trading to you. You're lucky because you are reading or listening to this before making a serious mistake. He hopes that the traders who take the time to know themselves and study their work will likely prosper. Now, if he were to summarize the discussion, according to Timothy, this book explains the complexities of trading psychology and the importance of the crucial mental discipline needed to achieve success in trading. This book is primarily focused on trading psychology and explains very well whether a trader will be successful in the long run. So anyone who wants to learn trading psychology and develop a winning mindset must read and listen to this book. Timothy Slater, President, Compute Rec Software, Inc. Friends, in the next episode, we'll discuss the book's preface. If you like his efforts, be sure to comment, like, and share it with at least 4 of your friends on social media. That's also the chapter title. Let's find out why Mark Douglas wrote this great book. Regarding the book's beginning, Douglas says that when he started working on it in the summer of 1982, every dimension of futures trading had grown. This included new exchanges, new contracts, more advisors and news services, a growing variety of books and publications, and more sophisticated technical trading systems than ever before, most of which made tracking the market easy through computer applications. However, despite the tremendous growth in trading-related services, one inevitable truth remained. there was still a very small group of sophisticated traders who took the largest share of profits from the market, which was more than 90% of all other traders, net losers year after year. Every dollar of profit earned by one trader in futures trading is equal to a dollar lost by another. If some traders consistently make large amounts of money, their profits are coming directly from the pockets of those thousands of other traders who honestly contribute to their daily wins. Some of these are very successful public figure traders, but most are only known in the Chicago or New York areas. It goes without saying that everyone wants to know what they do and how they do it to achieve these wins. The big difference between these two groups of traders, the small minority of winners and the vast majority of losers, is that the losers want to know what the winners know differently that they don't. The difference is that the traders who consistently make money on a weekly, monthly, and annual basis trade from the perspective of mental discipline. When asked about the secret to their success, they state clearly that until they learned self-discipline, emotional control, and the ability to change their minds to go with the flow of the market, they couldn't maintain consistency in making money from trading. Timothy first wants to clarify here that self-discipline, emotional control, and the commitment to learn to change one's mind have nothing to do with any kind of psychological problem, whether it's a news service, advisory service, new exchange, or technical or fundamental trading system. Secondly, from his trading experience, observations, and research, Douglas has found that all traders, including both winners and losers, experience some very common feelings. They all feel the pain of confusion, frustration, anxiety, and failure at the beginning of their trading careers. Some traders who overcome these steps to make money confront this and work through some very difficult psychological problems, contemplating what it means to be a trader. This process of winning and changing usually takes many years, even for the best traders. Mark also says that it's not necessary that any of us were born with the qualities considered to be the key to success, such as self-discipline and emotional control. On the contrary, these are characteristics that we acquire by learning some psychological skills. Acquiring these psychological skills is often learned through a trial and error learning process, which can prove to be financially very expensive and is usually full of emotional pain and suffering. The biggest problem with the trial and error method in trading is that most people lose all their money before completing this process. And other traders who have enough money to trade can never get past that psychological trauma.
It became very difficult for great traders to understand what they did, how they did it, and more importantly, why and how they took the steps to get where they got. Many people will happily share everything they know about the market and its behavior with others, but they don't necessarily know about their own behavior as an individual. However, they often warn people who demanded knowledge to understand that all the market knowledge in the world wouldn't do them any good until they acquired the necessary self-discipline and emotional control. How do you explain the necessary steps to teach someone how to do this, especially when they are interacting with an environment that is in perpetual motion and will always offer them the possibility that if they lost, the market would return to the same point where they bought? So you can see how difficult it is to understand why there's a need to cut a loss if they had one. It's even more difficult to explain how he can do something that suits his unique psychological makeup. How to apply this kind of wisdom? The easiest way to explain this, or even without really explaining it, is to say, okay, if you want to be a successful trader, you have to learn self-discipline and emotional control. Mark doesn't believe that this kind of abrupt advice is deliberately given for two main reasons. The first is that self-discipline and emotional control are abstract concepts that are not easily explained or understood. We all hear or read the words a lot, but ask anyone you know to define one of these concepts, and you will get a long pin-drop silence. The second is that today's successful traders started their journey without maps, signposts, or guidelines, or without knowing where they had to end up to accumulate their fortune from a psychological perspective, so that they remained in benefit. They had to discover that trading world, which was very demanding and time-consuming, through self-reflection and readjustment. They can give an explanation for having stumbled on more or less every mistake, with many mistakes being financially and emotionally devastating. At some point, they might have felt that something had changed about them, because the normal market activity that had a very negative emotional impact on them, such as anger, stress, anxiety, and fear, no longer had that impact. They must have gained a certain degree of self-confidence within themselves to respond appropriately to all possible market conditions, as there is a direct relationship between a person's level of self-confidence and the negative emotions mentioned. Self-confidence and fear are nothing but states of mind that are similar in the environment, but differ only in degree. As a person's level of self-confidence increases, the amount of their illusion, anxiety, and fear proportionately decreases. Here, confidence naturally develops because people have learned to trust themselves to do whatever is necessary without any hesitation. As a result of this self-trust, they no longer need to be afraid of the unpredictable and uncertain behavior of the markets. However, the main point he's making here is that the process of change that began here was in the mental environment and psychological makeup of each individual trader. Not that the market changed or the tools used changed, only the traders changed. Now, when traders undergo a transition in their personal development and learn a new skill on a trial and error basis, it's unlikely they will keep a detailed record of the steps of that learning process, especially a process that was characterized by pain, anxiety, and frustration. Obviously, if someone doesn't know exactly how they acquired the skill they just learned, it will naturally be very difficult for them to explain to someone else how they learned it. Moreover, when it comes to trading, once someone makes the kind of money they always dreamed of, there isn't much motivation to spend the time and energy necessary for an effective learning process from which other people can learn to achieve some profit. To explain how to become a successful trader requires a completely different set of skills from the skills needed to be a trader. Douglas says that the learning process and the kind of personal change necessary to enable him to write this book were different from the kind of learning process that Mark experienced as a trader. That's why this kind of book was needed and why it should be written. One learning process was chosen, and another was forced to be abandoned.
By force, Mark means that he had to lose his home, his car, and almost everything from which he had to learn some methods to change his perspective to stay effective in the trading environment. Losing all his possessions was a complete life-changing experience, an experience that gave him insights into the nature of fear and its impact on a person's ability to trade effectively, which he calls forced awareness. This is the place where the nature and characteristics of the environment he was working in were very different from his thinking, because finally he was forced by the market to accept many things about himself that he hadn't even considered. When all the external symbols representing a major part of his identity were gone, he had no other option. Then he was forced to see himself in a new and different way. These events happened to Douglas in March 1982, at which time he was an account executive at Merrill Lynch Commodities' Chicago Board of Trade office. Less than a year earlier, in June 1981, he had moved from Detroit. He left both Michigan and a successful career to go to Chicago to become a trader. He went to work for Merrill Lynch because he didn't have enough money to buy a seat on the Board of Trade or the Chicago Mercantile Exchange, and he didn't know he could lease a seat at the time. Douglas had an expensive apartment on Chicago's Gold Coast and a car. He was also maintaining a house in a Detroit suburb where his girlfriend and her 2 daughters lived, and Mark would drive between the 2 cities almost every weekend to see them. He was way over his head in trading. It would be very difficult to come to terms with the decisions he made to put himself in that kind of situation until he matured as a trader. When he went to Chicago, he had been trading for over 2 years. He had lost all his trading capital twice before going. Of course, he would quickly save and start over. His little time of success and some winning trades were enough to prove that he was trying. Once, he was very close to earning more than $250,000 on one trade, but he decided to buy the books he could get at the time and attend all the seminars he could afford. All the books he read said that if there was a big deal of financial pressure, it was very difficult to learn to trade or maintain success. If you have limited trading capital at that time, don't expect to become a successful trader.
If you're trading with less money, you can't tolerate a loss. He was clearly violating both of these rules because he had very little trading capital compared to his lifestyle, which he couldn't afford to lose it all. He also had a lot more evidence that nothing was in his favor. This proves that he came to Chicago because he believed he could meet people who knew how to trade, from whom he could also learn how they approached the action. At Merrill Lynch Commodity, where Mark worked, there were 38 account executives in the second largest commodity office. Mark was surprised to learn that he was the only account executive who had any experience trading with his own money. Then he was even more shocked when he found out that none of these account executives had any customers who were making money. In reality, the average customer would lose their principal within 4 months.
Douglas's biggest frustration came when he started meeting and befriending as many floor traders as possible, believing that if the people in the office didn't know how to make money, the floor traders surely were, who weren't confused or didn't know what they wanted to do and then did it. Mark isn't saying here that he never met traders who never made money. He just couldn't maintain it. He knew many traders who would make $2,000 or $3,000 in the first few hours of a trade, but they would always lose it again. Everyone here seemed to be suffering from the same kinds of problems and mistakes, but which no one really recognized as a problem. The possibility of the next trade always makes everything else in someone's life seem irrelevant. If the next trade could make you rich, why worry about anything? The traders Mark knew, including himself, were affected by this kind of big trade mentality. In fact, Mark's big trading mentality was so big that he would even refuse to take a profit of $500 to $700 on many trades when he knew it was possible. It may sound ridiculous, but he wouldn't take such a small amount of profit because at that time he felt like the market was insulting him by offering him such a small amount compared to his needs or expectations. As Mark's financial problems grew, so did his frustration, and he certainly found no comfort from anything happening around him. But he still held firm to the belief that he could get out of these difficulties. But by March 1982, just 8 months after moving to Chicago to pursue his dream of financial freedom, he was left with nothing but his job, apartment, clothes, a TV, and a bed. In other words, almost all the symbols that validated his identity were gone from his hands overnight. A large part of Douglas's self-concept, which included his home, car, and especially credit, was something Mark was always proud of. Now Mark had none of this. As he said earlier, it's not that there wasn't much evidence for the possibility of this happening, because it did happen. But there was a part of him that wouldn't allow direct conflict with this evidence. It was very easy to make excuses for all the things happening around him that he couldn't connect with. Refusing to face or consider all the contradictory information created a lot of pressure. And to make matters worse, he had an intense fear here that he would lose everything. But again, he tried everything possible to hide this fear and put it somewhere in his brain where he couldn't feel it. Yet a part of him must have felt this downfall. Otherwise, why would he be so distracted by fear? But how could he face any of these when he had no way to remove the imbalance that would be created from losing all these things? Here Douglas means that as his financial condition worsened, his mental defense mechanisms also broke down, and he finally accepted the inevitability of the act that he believed was the ultimate act of failure, bankruptcy. As a result of this experience, many things changed within Mark and life. The first thing that happened was quite surprising. His stress disappeared, and he took a big sigh of relief because there was nothing to predict, fear, or try so hard to protect. While he was going through his worst fears, he found that there was actually nothing about that situation he couldn't handle. It actually wasn't as bad as he thought it would be. He was still alive and breathing. His understanding and deeper understanding of the fundamental nature of his identity began to grow. Mark mostly grew up believing that who he was included his things. The more possessions he had, the more person he created. What he started to feel was that he was much more than the things he had accumulated. When the mask was removed, it allowed him to feel this deeper dimension that up to this point he had undervalued himself as a person. He started to learn that there was a certain freedom in allowing himself to be wrong. As long as something positive and useful is learned from the experience, it probably doesn't seem to matter.
They didn't relate these personal experiences because they felt that, except for one, they were specifically just that. Everyone knows that there are many traders who lose everything, and while some of them will come to a similar awareness about themselves, due to financial necessity, they will not be able to do so as a trader. Mark was also not in a financial position to continue trading unless he had a job at Merrill Lynch. In fact, for him, it was normal to act as if nothing had happened. He certainly wasn't going to let his customers or anyone in the office know that he had filed for bankruptcy. His job as an accounts executive was one of the few things he had left, and for Mark, it depended on whether he was a good trader or not. This is a key difference for Douglas, which ultimately led to the creation of this book. He was lucky that even though he didn't have his own money, he was still able to continue trading.
The mental game of trading. The major shifts that were occurring put Mark in a unique position to examine and study the state of his internal mental environment, which also affected what he perceived in the external physical environment. This relationship between the internal and external isn't always so obvious, but in this situation, it was undeniable. He learned that the market provides traders with the opportunity to profit from price movement, and this opportunity is in an essentially perpetual motion. It's an environment where an individual has the freedom to create their own results, free from many of the constraints that exist in day-to-day social life. These never-ending opportunities make the market a perfect mirror for a trader's mindset. The market has no control over what a trader sees in those movements and what they do about it. All the power to transform the 24 into an experience resides in each trader's mind. For example, if Douglas saw the market as a threat and was afraid of what it might take away from him, it wasn't because the external situation was actually threatening him in some way. It became very clear to him that his fear was the result of his inability to predict events or to perform in a way that best served his own interests. He lacked the self-confidence to do what was required to be done. That's what he was actually afraid of. Additionally, Mark discovered that his mental framework was designed to avoid losses at all costs, and in his desperate attempt to do so, he was actually creating them. You can think of it this way. None of us has the mental capacity to be aware of everything in the environment at once. The environmental information that we focus our attention on will be the information that is most important to us. As we focus our most attention on certain types of information because of its importance, we are at the same time systematically keeping other types of information out of our awareness. Mark incurred losses not in spite of trying to avoid them, but precisely because he was trying to avoid them. Instead of focusing positively on market information that indicated a potential opportunity, he was more preoccupied with the information that he was most afraid of. Consequently, the other possibilities that he was being deprived of at any given moment were opportunities. And in order to keep his attention off the market information that related to opportunity, he was creating something. He had no way of knowing what he was losing until the importance of losses and his belief about being wrong began to change. Once this shift in perspective occurred, he began to notice characteristics about the market's behavior and the relationships between those characteristics that he was completely unaware of. At one point, he also had the realization that since he had already lost everything, there was nothing for him to be afraid of. And as a result, he unknowingly learned the most important lesson for becoming a successful trader. As his fear of losing disappeared, he began to see and experience a different market, and he was also a little different himself. It was as if someone had removed a black blindfold from his eyes. Up to that point, his trading had always been influenced by his fear. He had no idea what it would be like to trade without fear or how it could be done.
It also became very clear to Mark how his fear had prevented him from understanding why it was so essential to follow certain well-defined market and money management rules. It all started to make sense. The more he followed his rules, the more he trusted himself. The more he trusted himself, the more he could focus his attention on the micro-relationships of market behavior so that new ideas about the market could come in. This had a profound effect on his ability to operate in the market. The less he worried about whether he was wrong, the clearer things became.
it became easy to move in and out of a state of mind, minimize his loss, and prepare for the next opportunity to profit. By June of 1982, Mark had started consistently making money for his clients who depended on him for their trading. This was not a lot of money by most traders' standards, but nevertheless, his winning days were now becoming winning weeks and months. Then, in August of 1982, he thought about writing a book or at least doing a seminar to help other traders understand what he had discovered for himself. There was a definite vacuum in the body of knowledge about the market in the field of education. There was no material, in fact, that would help a person understand why trading success is so elusive. Mark has addressed trading psychology on a deep, insightful level. Mark has written this book to address those people whom he believes have a critical need for an organized, systematic, step-by-step approach to learning the mental skills necessary to accumulate wealth as a trader. The secret of this approach is to learn a new way of thinking.
Mark's understanding of this hypothesis is that the people who developed the program went to the South Pacific and found people who demonstrated the ability to walk over hot embers with their feet without suffering any physical harm. After finding some of these South Pacific firewalkers, the program developers began to analyze their beliefs and attitudes in order to arrive at a way of thinking that they could teach in the United States. Mark is sure that he does not need to inform you about the physical and mental effects of the endeavor of walking on a red-hot bed of hot embers with bare feet. The fear that stems from the idea of doing so will typically be intense. The physical and mental effects of the endeavor of walking on a red-hot bed, you don't need to be informed about the physical and mental effects of informing about doing so. You don't need to be informed about the physical and mental effects of informing about the physical and mental effects of informing. You have to question some of your beliefs and test your notions of what is possible. Sometimes, only a complete mental household cleaning can make space for success by moving you away from failure. Trading is very competitive and also creates an emotionally stressful environment. There's the fear of financial ruin, along with the compelling need to win millions. The market entices a trader with the very real possibility of fulfilling their dream of financial freedom, while at the same time being ready to take everything they have. Also, the principles of time, effort, and reward associated with most job situations do not apply in the market. For example, in many jobs, due to an hourly wage or annual salary, regardless of effort, a trader can earn a huge profit in a few seconds, which costs them only mental energy. At first, you might think, what's wrong with earning a lot of money in minutes or seconds? A lot. Whether you're aware of it or not, most of us grow up with a highly structured belief system about the conditions for how much money we are worthy of earning. In fact, many people feel they are not worthy of money they haven't worked for, due to their childhood conditioning and religious training. Surely, earning a lot of money in a very short time without any effort does not fall into the definition of working for their money that most people have. So, how can an individual reconcile with big profits against this structured work belief, especially when they might not even be aware of it? If they knew, they wouldn't worry about it. Such a mental conflict can usually be resolved by the trader finding a clever, simple, or worldly way to give their money back to the market. Not being able to keep up with the differences between the cultural and trading environments, or just being ignorant of the fact that the discrepancies exist, can certainly cause most of the trading mistakes made by traders. Still, a way of thinking can not only redefine market behavior in understandable terms to prevent such mistakes, but also manage most, if not all, of the common undisciplined mental responses to that behavior. Culturally learned behaviors that result in an unsuccessful trading experience in mentally charged situations where a decision needs to be made in 2 seconds might not even come to your attention when compared to current events, because the current situation is so immediate that you might not have a clue how common and even thoughtless your behavior can be.